It's the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Okay, so those in the audience that are investors, many people are new at this, and so they're looking at term sheets, wondering what some of these terms mean. And so just wanted to walk through some of the key term sheets that people ask me about from time to time. If you have any questions, put it in that chat box. But some of the key terms that we often come up with that we want to talk about are things like, if you understand some of the financial parameters to look for in a term sheet, it will help you. What type of security is this? A safe note, convertible note, price round? How much is the investment amount that they're asking for overall? And then also, what is pre-money valuation? For those who are unfamiliar with startups, we use the pre-money world rather than share price. And just to give you the equation of ownership, pre-money plus investment equals post-money. Investor will get the investment divided by post-money as a percent ownership stake. Sometimes you do see price per share and price rounds, and you want to look at safe notes and convertible notes as to what are the conversion triggers for those. Make sure there are conversion triggers in the term sheet is what I found. And then sometimes there are dividends as well. So some of the key things to look for there to help you. Term sheets are either slanted toward the founder or they're slanted toward the investor, and we sometimes try hard to balance it between the two. But if you look at a term sheet, these are some symbols that tell you that you're looking at a founder-friendly term sheet. There is no expiration date on the investment offer. The option pool comes out of both the investor's portion as well as the founder's portion. Typically in a Series A, you set aside 15% of the shares to pay the employees. Well, it goes up to 20 if you go to later stage. And so somebody has to pay for that. Who is paying for that? There is no confidentiality agreement. The founders are free to talk to anyone about the deal. There is no liquidation preference for the investors. That means it's a very friendly founder sheet. And finally, the startup does not pay the investor legal fees. If you were to invert all of this, you would have an investor-friendly term sheet. So next time you look at a term sheet, you might want to think about which of these things are at play in the one that you're looking at. When you're going into a term sheet, I always say it's not a formula, it's a negotiation. Always think about this because valuation, while there may be metrics and there be standards for how you calculate valuation, ultimately it is a negotiation between the two. Liquidation preferences are also negotiated. Sometimes they're in, sometimes they're not. If the investor doesn't believe the company is at the valuation that is being asked, well, a liquidation preference can sometimes balance things out. Investor or founder share rights can also be balanced out as well. And you can also include redemption rights. We'll talk about that more here in a moment. One of the most common tools out there is the convertible note. Basically, it's a debt instrument that converts to equity later. And it's valuable because it's a rolling close. You take the note out, go talk to investors as a startup, and they sign the check, you sign the note, the money goes into the business the next day. You can actually stack up several notes, one on top of the other. If you stack up too much, you will be undergoing greater dilution than you think, so you have to be careful about that. And so you also have to look that you don't raise too much money on convertible debt, as if when you get to Series A, there will be venture capital and institutional investors that will expect a certain amount of the deal in order to come in. If you've given out too much already with convertible notes, it may be hard to bring them in. Also, it's very good for seed rounds and bridge rounds. You don't necessarily need a lead investor to go into it. Avoid setting the price in the very early stages. It's very hard to find a lead investor because there's just not enough information to make a decision about this. And it can keep the cap table simple. When the note matures, it will convert, or if there's a follow-on qualified pricing round, it will convert at that point as well. One thing about convertible notes is that they typically don't have any protective provisions, very little about, sometimes they have information rights, but not anything with boards or the other things that you may want to go in there. The Angel Capital Association came out with a model convertible note term sheet this past year that put many of those investor rights back into it. I recommend you look at that. The valuation is not fixed. What you have instead is a valuation cap. That means that the valuation will not be higher than that number. And if it converts it without a qualified pricing round, it will convert at the valuation cap. The other disadvantage of a convertible note is that you don't get any qualified small business stock tax benefits, 1202, 1245, and the like, because you must be in a equity deal for 5 years before QSBS comes into play. But it is a great way to start off an investment round when you don't have anything else. I brought up the convertible note because we have a new convertible note ourselves. We call the 3X and 3. It basically gives the investor at their sole discretion a redemption right at year 3. At year 3, I found in most deals it's very clear which way this deal is going. We're continuing up the equity track, or we're now going sideways. If we're going sideways and it doesn't look like the rocket you thought it was going to be, investors can redeem their investment for 3x the amount. You put 50K in, you get 150K out, and it moves to a revenue share agreement to give you a path out of the deal. For those who are interested, we're rebuilding our 3X and 3 group. We've had this in the past and have had several deals. We have more companies coming to our program now that are very interested in 3X and 3. So if you're interested in that, give me a call. Let me know, and I'll be glad to add you to the list. There's no cost to join. You just get to review deals that are interested in that. In most of these deals, they take 250, 500K, but no more. We have to limit how much they can take. So there's limited amount of space. But if you're interested in that, we have a lot of startup interest in 3X and 3. Many of them want to actually have you take your shares out, convert out of the deal because they want the equity back for themselves. So with that, let's go ahead and we're going to close out our session now, the formal session, and we're going to move into breakout rooms. We're going to put breakout rooms up on the screen here. Kat will take us into it. If you want to talk to me, I'll be in a breakout room. I'd be glad to talk to you about 3X and 3 or as joining the 10 Capital program. And our other founders will be in their room. Welcome you to go join and talk to them as well. So with that, I think we got the breakout rooms here on the screen. You guys can just click on that button and click join for the one you want to go to, and we'll see you there. That wraps up our program today. We want to thank you guys for joining us. We'll send out the recording and the details from this event afterwards, and we'll be back next month with another investor education session. Thank you so much, Vadim and Nola, for great questions today. Appreciate you joining us. Looking forward to joining you in your sessions in the future. With that, we're going ahead and close it out and join the breakout room. Thanks so much. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.